Hey guys, hope everything's going well. You guys know the drill. Smash that like button, subscribe if you haven't, and comment down below. Follow me on Instagram at AIH_sports. So today I'm going to be doing a video more on the economy and inflation, how it relates to sports cards. And I'm going to try to look at a little bit of what I think is going to happen in the future. And I know some people are going to say, some from the collecting end, saying that, hey, who cares? I'm collecting. And I would respond, okay, if you are collecting a $4 card, this video won't matter to you. But if you're collecting an expensive card, don't you want to get it cheaper? And in my opinion, there are times, if you're designing a card, it's better to buy it in a time where it's most likely going to be cheaper. Doesn't mean that's going to happen for every card, but it's just looking at the market as a whole. And from an investing standpoint, I believe this is really an important video, because some people say, hey, where are you coming up with your information? You're just coming up with information out of your behind. But I wanted to look at this. Okay, this is the New York Times, okay? And the New York Times is part of the mainstream media, and they're even acknowledging rapid inflation fuels debate over what's to blame, pandemic or policy. So they're acknowledging we have inflation, and usually the media doesn't talk too much about inflation, but if it's really bad, they do. And we have it, and we've seen that the sports card market has benefited from it. And I always show you the interest rates, and I show you negative interest rates versus positive interest rates. And I've showed you in previous videos, I look at the data from the Federal Reserve's website. Positive interest rates here, this is a 10-year, by the way. And if you're here, you see it's negative. Okay. And what I've said all along, if you are investing in collectibles, in my opinion, I'm not telling you what to do. My opinion is better to buy collectibles when the interest rates are positive, meaning if this is the 10-year. So if you take the 10-year yield minus the expected inflation rate, and if that's positive, that means most likely sophisticated investors are not putting in as much money in the collectibles arena. People usually want to pour all this money when rates get negative. And before the pandemic, if you noticed, the rates were going negative, okay? And I remember some of my sports cards. I remember Mahomes' card, even though he was doing well, that card, the Optic Hollow PSA 10, his rookie card went from like 100 some bucks in the fall to about 800. So that was interesting. Yeah, he did win the Super Bowl. I get that point. And then here was another good buying opportunity, positive rates. Okay. So yeah, during the pandemic, rates have been positive. It's been fluctuating up and down, but it didn't go to positive. So it's been a good bull market. What I've noticed though, the past month, the interest rates are negative, like negative 1.02, around there. And then in the past month, it's gone up, close to 50 basis points to negative 0.50 basis points. Now, granted, I expect this to reverse probably in the coming months. Stock market has been going down as well. But I've been saying this, the trend is most likely higher in the next few years. And that, in my opinion, is going to be bearish for sports cards. There are also some other charts that I'm just looking at. The sports card market hasn't, if you look at majority of the cards, and PWCC has an index. PWCC 101 cards that they ranked at 2,500, it really hasn't been increasing significantly as it did in early 2020. You could see the huge run up here and there. I don't want to look at the top 100 or top 50 because that doesn't have data where you see sales all the time. Those are sales that happen once in a while. Okay, and then one of the other videos where I didn't do, in my opinion, a good job explaining this topic. I should have used graphs, and I should have done a video like this explaining my take on this euro-dollar futures curve. And I know this topic is not talked about in the media, but this was a guide to showing there would have been, or as a precursor to the pain that you saw in 2008, this curve showed there was tension brewing in 2006. And then in 2018, the same thing before the pandemic, 1.5 years. And basically, how a curve works, it should be upward sloping, okay? In a normal market, whether you look at the yield curve or whether you look at this euro-dollar futures curve. And the euro-dollar futures curve basically shows basically stress in the 3-month LIBOR, basically what's used for funding. And long story short, you see this curving up, but then there were times in the last month or so, there was inversion, okay? And this author at Alhambra Partners, I think his name is Jeff Snyder. You could like YouTube his videos. They're now complicated for those that don't follow the financial markets. You can see all these curves getting inverted. Now, this is showing pain in 2024, and I outline in 2024, I expect some issues in the markets. And this is early on. Now, it's only happened for the past month, but you're seeing sophisticated traders showing the curve is getting inverted. And this is different weeks, okay? So this one is what, 1.7 showing inversion, late 2024, if you see here. You see this 114, you see an inversion, okay? It's not upward sloping. You see how this slope looks good? Now you're seeing a little bumps in the road. And then last month, you see it upward sloping and then bumps in the road. So then how could you look this yourself without going to websites like Alhambra Partners or trying to get information from YouTube? Well, the CME has quotes. CME is basically the exchange where majority of the futures contracts are traded. And long story short, you could see different months while this loads. Let this load. But basically, you can see different months loading, and not different months loading. You could see the slope of the curve, and I'll show you starting from here, or you could just look at the data. You see February, okay, 99.67. Okay, you take 100 minus 99.67, so that's about 0.33, okay? In March, it's 100 minus 99.565, so that's what? 0.44. You see this is 0.33, 0.44 about. So that's showing that it's an increase in the yield, okay? Which makes sense. And we see this happening all the way to December 2024. This is like the latest that I've looked at. And ultimately, you see over here, it's 98.01, okay? And before in June 2024. So this is still technically upward sloping, okay? But then you see this 97.99, and then in March of 2025, 97.995. What does that mean? It means that there is an inversion, and you see an inversion happening all the way until what? September 2025. So why would sophisticated traders believe, or why would they trade this way? Why would they price March 2025 as an inversion to the curve? That means they believe there is potentially stress in the financial system down the road. Now, right now, even though the stock market has been coming down, I do believe it will recover. But it just shows us that the economy will most likely face stress probably late 2024, according to these traders. Now, this is subject to change. There could be different things that happen in the economy to change it, but we're talking about really sophisticated traders pricing in risk down the road. And that inflation that we have right now will temporarily turn to deflation. In my opinion, I want to buy when rates are positive. And I believe in the 2024 timeline, the rates will be very positive, so right around late 2024, 2025. I've been projecting this. And then people say, where are you coming up with this 2024 thesis, right? Where are you coming up with this? Like, I get attacked in the comment section, that's fine. And I use different individuals' data. There's one guy, Martin Armstrong. I know some people will say, oh, he did this and that, but I still like the work that he does in terms of cycles. And one of the things that he stated, or what his pi cycle, it tends to be, or it seems to be topping out May 7th, May 8th of 2024. Okay. And he called the bottom in the confidence in the economy. This was what, May 2020. This was, I think, when the craziness was going on in our society. You had a lot of tension, you had lockdowns, and I believe there are the riots at that moment. And this was the time probably to buy the stock market, buy all these assets. So if his pi model is correct, 2024. And I don't look at him as well. I also look at this guy, Avi Gilbert. I said this in many videos, and he believes that the economy will be facing pressure in 2024 as well. 2023 at the earliest, 2024 at the latest. That's what he said. So I'm not looking at one guy. I'm just looking at a bunch of individuals and the way that they use cycles. Avi Gilbert uses Elliott wave. Martin Armstrong uses his own pi cycle. So I'm just looking at a lot of data. I'm open-minded to, changing my interpretation. But as of right now, I personally want to be selling the cards that have gone up significantly during this inflationary environment. My rule of thumb is if inflation is getting out of control, even the New York Times has admitted this, I want to get out while times are good. And there will be, in my opinion, good buying opportunities. And in terms of investing, I want to buy here. And I got lucky in 2018. I just went to an antique store and I happened to get interested in sports cards around this time. And now in this environment, this inflationary environment, I've been slowly but steadily selling my high-end stuff. The only cards or autographs that I'm willing to buy, yes, some for my collection, like usually under $100 for autos. And right now, specifically, I'm looking for autographs under $30 that are authenticated by PSA or BGS of Hall of Fame guys. And there are opportunities out there. Now, it may take time. Sometimes you have to negotiate with people. Most people won't accept the bids or offers, but yesterday I was able to get a discount of approximately 60% on an item. Granted, he charged $8 for shipping, but still, a $50 autograph I was able to get for 20. But then I have to pay shipping, so it's 30. Okay, still, I find that to be a hell of a deal. Okay, there are people that are desperate to sell Hall of Fame individuals. These are older individuals. And yeah, I got one yesterday for 16 bucks, Hall of Famer, PSA authenticated, free shipping. Okay. So I'm just looking for things that I believe are undervalued. And on top of it, if you want to send, for instance, some of these cards to PSA, I've determined that it's approximately 40 bucks if you return back to normal days of grading. I'm not talking about the $50 you wait in line in the first 200 or first 2,000 get a $50 submission. I'm not talking about that. I'm talking about if you return back to normal times, if we ever do, $10 card, okay, for items at less than 100 bucks. The cheapest you could get graded, slab, whatever, 40 bucks. If I can get items under 40, I consider that a victory. Now, the market may not price it right now, but there could be opportunities. You buy during the off season. I'm buying like a lot of baseball autos right now of Hall of Famers. It's off season. So I expect when the season were to continue, those prices will probably go a little higher. And there could be other events that could cause those guys to go higher. And yeah, that's what I'm doing. So like all the major purchases, in my opinion, during this inflationary environment, I would not do. Granted, you could still make money if you bought Joe Burrow earlier in the year. Okay, you're doing okay right now. If you bought Aaron Rodgers after the first game of the year where he did poorly and you sold right before his loss yesterday, okay, you could still make money in my opinion, but it's just going to be much, much harder to do so than just buying and hoping. And I believe this looking at inflation, looking at real rates versus negative rates can definitely help people investing. I see people saying that, oh, cards are not investments. Well, you can invest in cards, but you just got to be a little smart about it. You got to understand monetary policy. That's just my opinion. Anyways, guys, let me know what you think. Smash that like button, subscribe if you haven't, comment down below, guys. Thanks. Bye.